Last week, you had a good setup. The chart was clean, your rules were clear, but your position size was too big. So when price moved slightly against you, you closed the trade early, and 5 minutes later, it hit your target. That moment right there is the story of most losing traders. Here's the part no one wants to admit. The problem was never your analysis. It wasn't the indicator. It wasn't the market. It was the size. Because the moment you traded too big, your trade stopped being a probability and became a personal threat. You weren't reading price anymore. You were reading your emotions. When you trade big, every small pullback feels dangerous. Not because it is, but because your account can't emotionally handle it. Your stop loss starts feeling too far. Your target starts feeling unrealistic. And suddenly, discipline feels optional. This is how good traders turn into reactive traders. Most people think professional traders are fearless. They're not. They're protected. They protect their capital. They protect their psychology. And they do that by trading small. Because small size gives you something rare in trading. Time. Time to let the trade work. Time to be wrong without damage. Time to stay objective. When you trade small, you don't need to be right immediately. You don't need the market to respect you. You don't need to prove anything. You simply execute, and execution, repeated over time, is where real profitability comes from. Not from big wins, not from adrenaline, but from consistency. Here's the truth most traders ignore. Trading small doesn't slow you down. It removes the things that keep stopping you. Fear, overthinking, emotional exits. That's why traders who trade small stay in the game long enough to actually win. In the next part, we'll talk about why trading big feels so tempting and why the market quietly uses that against you. Stay with me. This is where everything starts to make sense. Now let's talk about something uncomfortable. Why does trading big feel so tempting? Because trading big doesn't just promise money. It promises relief. Relief from past losses. Relief from self-doubt. Relief from the feeling that you're falling behind. Most traders don't increase size because they're confident. They increase size because they're tired. Tired of waiting. Tired of slow progress. Tired of feeling average. So they tell themselves a story. This trade is perfect. This setup can't fail. I'll just size up this one time. And that's how the trap closes. Here's what happens next. The moment you trade big, your mind starts negotiating. If it comes back a little more, I'll exit. I'll give it just a bit more room. Let's see one more candle. This isn't strategy. This is survival mode. Your brain is no longer focused on execution. It's focused on damage control. And the market doesn't care that you're uncomfortable. This is why trading big destroys consistency. Not in one trade, but over time. One emotional exit here. One oversized loss there. One revenge trade you swear was controlled. Slowly, your confidence erodes. And once confidence is gone, every decision becomes heavier than it should be. Professional traders understand something most retail traders don't. The market doesn't pay you for courage. It pays you for repetition. The same setup, the same risk, the same behavior, again and again. Trading small makes repetition possible, because when risk is small, mistakes are survivable. And survivable mistakes are how traders learn. Think about this. If one losing trade can emotionally ruin your day, your size is already too big. If one win makes you feel invincible, your size is already too big. Both reactions come from the same place. Too much emotional exposure. Trading small keeps you mentally flat, and flat emotions are not boring. They're powerful. This is why trading small builds real confidence. Not the loud kind, not the social media kind, but quiet confidence. The kind where you don't need to watch every tick. The kind where you don't need to hope. The kind where you trust your process, because you've survived it hundreds of times. Most traders are trying to feel something in the market. Excitement, validation, escape. Professionals are trying to remove feeling altogether, and the fastest way to do that is to trade small. In the next section, we're going to talk about how trading small actually compounds faster than trading big, even though it doesn't feel that way at first. This is where the math and the psychology finally line up. Let's talk about something traders love to ignore: the math. Because emotionally, trading big feels faster, but mathematically, it does the opposite. Imagine two traders. Both have the same strategy. Both have the same win rate. Both take the same setups. The only difference? One trades big, the other trades small. The trader who trades big wants results now. So when he loses big. A 10% drawdown becomes 20, 20 becomes 35, and suddenly he's no longer trading to grow. He's trading to recover, and recovery trading is where accounts quietly die. The trader who trades small experiences losses too, but his losses are boring. They don't hurt enough to trigger revenge. They don't hurt enough to trigger panic. They don't hurt enough to change his behavior. So he keeps showing up. Same setup, same risk, same execution. That's compounding. Here's the truth. Most people don't understand. Compounding doesn't come from big wins. It comes from staying consistent long enough for small edges to stack. You don't need a massive green day. You need hundreds of normal days, and trading small is the only thing that allows that. Big size creates uneven equity curves, sharp spikes, deep drops. Small size creates smooth curves, and smooth curves compound. Because drawdowns stay shallow, because confidence stays intact, because discipline doesn't get tested every single trade. Most traders blow accounts not because they're wrong, but because their size doesn't forgive mistakes. The market is already uncertain. Why add emotional pressure on top of it? Trading small gives you room to breathe, and breathing room is what lets probability work. Here's a question you should ask yourself honestly. Can you take 10 losses in a row without changing your behavior? If the answer is no, your size is too big. Because losing streaks are not failures. They're part of the distribution. Professional traders plan for them. Amateurs are shocked by them. Trading small doesn't protect you from losing. It protects you from yourself, from forcing trades, from skipping rules, from trying to make it back. And avoiding those mistakes is what actually makes traders profitable. This is why trading small feels boring. And boring is exactly what works, because boring lets you repeat the process. Boring lets you survive drawdowns. Boring lets compounding do its job quietly. In the final part, we'll bring everything together. How to think about size correctly, what small actually means, and how to shift from excitement-based trading to professional execution. This is where the mindset finally locks in. Most traders ask the wrong question. How much can I make on this trade? Professional traders ask something very different. How small do I need to trade so I can execute this trade exactly as planned? That one question changes everything. Proper position sizing is not about numbers, it's about behavior. The right size is the size that lets you stay calm when price moves against you. The size that doesn't make you stare at your P&L, the size that doesn't make you hope. If a trade makes you emotionally lean forward in your chair, your size is already too big. Here's a simple mindset shift. Your position size should be so small that losing feels acceptable, not painful, not frustrating, just normal. Most traders think confidence comes from winning. It doesn't. Confidence comes from knowing you can lose and still execute the next trade the same way. That's what proper size gives you. Not comfort, control. When your size is right, you stop trying to predict. You stop needing the market to agree with you. You simply participate. And participation, repeated over time, is how edge becomes income. Here's how professionals think about size. They don't ask, can I afford to lose this? They ask, can I think clearly if I lose this? That's the real cost of a trade. Mental clarity. And most traders spend it too cheaply. Trading small is not playing it safe. It's playing it smart, because the goal was never to feel something in the market. The goal was to stay long enough for skill to matter. And here's the quiet truth. The traders who last are not the boldest, not the loudest, not the most confident on social media. They're the ones who learn how to make losing boring, and boring is what builds real profitability. So next time you place a trade, don't ask how big you can go. Ask how small you need to be to stay exactly who you are when the market doesn't cooperate. If you can do that, you're already trading like a professional, and once trading stops feeling emotional, that's usually when it starts working.